Welcome, and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, June 21st. Now, right off the bat, I must clarify that I'm not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line, and from this podcast. Just this week, in fact, I wrote to my paid subscribers about a couple more stocks that I am adding to my active high priority watch list as we enter the Q2 earnings season. I also wrote to them about a stock that I've owned for about a couple of years now that I recently exited just 4 days after I wrote a very positive Q1 earnings report on the company. This is active portfolio management in Beachland, active portfolio management in the works. We invest in the market that we are given and not in the market that we want or hope to see. So please consider becoming a paid subscriber. Tell your friends and family, and I'd love to have them and you join the growing Beachman community. Now, before we get into the meat of this episode, a few quick PSAs. I've mentioned before, but I wanted to mention it again. This podcast is also available in YouTube format. If you search for Market Whispers by Beachman, you should be able to find my channel on YouTube. Secondly, you can follow me on Twitter or X. If you get on Twitter or X and search for Beachman, you should be able to find my handle. I'm also going to include a link to my Twitter handle in this episode. Thirdly, you can also listen to this podcast on your favorite podcasting app or also on the Substack app. If you go to the webpage for any episode, you can find the buttons that you can use to set up a direct feed into your favorite podcasting app queue. For example, I was able to set up a link between Market Whispers podcast and my Apple Podcasts app. So anytime I put up a new episode in this podcast, for this podcast, it appears in my Apple Podcasts queue and I can listen to it there as well. And lastly, before we get into the episode, please take a few seconds to like this episode or drop a comment. I have opened up comments for all listeners, free as well as paid subscribers. I'm personally too old to care about likes and thumbs ups, but the algorithms on Substack and YouTube, well, they do care. Your likes and comments help with increasing readership engagement so that more users, more readers, more people can find my writings, find this podcast, and help us grow the growing Beachman community. Now on to the meat of this episode. Well, in today's episode, we will cover the current state of the markets. We'll figure out what's the word on the street. We'll talk about what's coming up in the markets over the next 2 weeks, and we'll wrap up with some final thoughts. But our main topic for today's episode is the state of the consumer in the US as we head into the summer. We'll take a look at how the consumer is doing in the US and what its implications could be for the US economy and the markets. Talking about markets, let's talk about the current state of the markets. Well, for this week, the S&P 500 went up by about 0.6%. The Nasdaq was flat, and the Dow Jones added about 1.45%. So far this year, the S&P 500 has added about almost 15% for the year. The Nasdaq has gained almost 18% for the year, and the Dow Jones has gained about 4% for the year. Now, it's been more than 330 days since the S&P 500 has recorded a decline of 2% or more. This is the longest stretch of such no 2% plus decline since February of 2018. So far in 2024, the S&P 500 has closed at a new all-time high 29 times. The run rate for this year puts us at potentially hitting about 63 new all-time highs by the time we end 2024. If this happens, this could be the third best year for the S&P 500 since 1978. Now, Goldman Sachs thinks that the S&P 500 is behaving this year in 2024 similar to how it traded in 1995. Goldman says that 2024 is giving off major 1995 vibes so far. The last time we got a soft landing was in 1995. During that year, the Feds cut interest rates from 6% down to 5.25%. So those would have been 3 rate cuts of 25.25% each. And the S&P 500 saw 77 all-time highs that year, all-time high closes that year. Now, so far in 24, we've already seen 29 such all-time high closes. And the Feds are projecting to cut rates at least once this year. Markets think they're going to cut rates at least twice. So the soft landing theory, the soft landing thesis is now becoming a growing consensus among investors and markets. Last week, the S&P 500 took a step function higher after the US Fed's meeting, their June meeting. The S&P 500 moved from the 5300s all the way up to the 5400s, based on higher confidence that we might get 2 rate cuts this year, even though the updated Fed's dot plot told us that they were only going to give us 1 rate cut in 2024. Now, the question on the table is whether the index can find a more comfortable home in the 5400s, whether these new levels can act as some sort of downside support, or whether they will prove out to be a topping signal for markets. Meanwhile, the average stock in the S&P 500 is just about where it was at the start of 2022, about 2.5 years ago. More than half of the current stocks in the S&P 500 are actually down since the beginning of 2022. Now, Market Lab from Substack, they gave us some interesting stats this week on the NDX, on the NASDAQ 100. Market Lab told us that the NDX is up 7.5% over just the last month. But under the hood, only 50% of the stocks in that NDX 100 index are even up over this 1-month stretch. And nearly 70% of the gains of the NDX 100, of the NASDAQ 100, can be attributed to just 3 stocks. Well, those 3 stocks, I'm sure you can guess which ones they are. It's NVIDIA, it's Apple, and surprise, surprise, it's Broadcom, ticker AVGO. Meanwhile, small caps seem to continue to be hated by markets. I mean, just all around, just hated by markets. The Russell 2000 index of small companies are down 17% from their peak in November 2021, and they have made absolutely no progress all this year. The Russell 3000, which is another index of small cap stocks, 17% of the stocks in the Russell 3000 are at new 3-month lows. Now, we are getting several new, as markets are rising, as markets are grinding higher, we've been getting several new year-end price targets for the S&P 500 from the various brokerage and investment and research firms. Evercore, they raised their year-end target for the S&P 500 to 6,000 points. Goldman Sachs, they gave us a new year-end target of 5,600 for the index, for the S&P 500. But 5,600 is just Goldman's baseline scenario, and they gave us 3 other scenarios to consider. One, what they call a catch-up scenario. The S&P 500 could end the year up at 5,900, so that's higher than their baseline of 5,600. The other scenario they gave us was if mega caps continue to be bid up, let's say this concentration of market returns in just the large mega cap stocks continues through the end of the year, the index could hit as high as 6,300 points by the end of the year, which is another increase of 16% from now. The down scenario that they gave us, they have to give us a bearish scenario. They told us that in case we have a recession, Goldman Sachs told us that the S&P 500 could drop to as low as 4,800 points. Now, JP Morgan, they told us that while they thought that the markets were setting up for a pullback based on the price action during the recent Q1 earnings season, based on the narrowing breadth of stocks that are giving us new all-time highs versus those that are seeing new all-time lows, based on the reduced hedge fund positioning in stocks, JPM thought that markets were ripe for some sort of pullback. The potential for markets to take some profits, given that 32% gain in the S&P 500 since the bull run started in October 23. And that bull run actually, so the S&P 500 gained 32% since October last year, and the NDX, the Nasdaq 100, has gained about 39% since that time frame. So they thought that it would have been natural for markets to take some sort of profits off the table because of these various dynamics that are playing out. But this pullback has not come to fruition. The near term actually points to markets going another leg higher rather than a pullback. And the macro data that we're getting continues to support this hypothesis as we get into what is a seasonally strong July. Typically, June is one of the weaker months in the markets, and seasonally July is a strong month in the market. So as we head into July, JPM's expectations for a market drop haven't really materialized. Now let's talk about our favorite stock, NVIDIA. I mean, we can't really talk about the state of the markets without talking about NVIDIA. The S&P 500 has been soaring to new all-time highs, primarily driven by one single stock, NVIDIA. Yeah, the mega caps are contributing to it as well, but NVIDIA's contribution to these new all-time highs in the S&P 500 are really outsized as compared to some of their peers. Now, if NVIDIA stops performing, let's say for whatever reason the market is not enamored with NVIDIA anymore, let's say for whatever reason the demand for AI GPU chips weakens, let's say for whatever reason investors think that all of this AI stuff is a bubble and hype, and people start walking away from NVIDIA, the question is, will the markets continue to rise? Can they depend on the remaining 499 stocks in the S&P 500 to continue to support it and take it higher? We know that NVIDIA and Apple and Microsoft are still battling it out for the crown of being the largest publicly traded company in the world. Now, I haven't looked at where they are as of the end of today, Friday, June 21st, but they've been going back and forth the entire week. At one time, NVIDIA's on top, then Apple takes it, and then Microsoft gets on top. I mean, NVIDIA reached a value of more than $3.3 trillion on Tuesday this week, right? Jensen Huang, he's become one of the world's richest people this week with a new net worth of over $120 billion. The shares of NVIDIA have surged as much as 180% year to date, and over 200% in just the last 12 months, driven by a significant demand for its AI chips. NVIDIA's market cap has risen more than tenfold over the past 4 years, from $323 billion in 2020, just 4 years ago, from $323 billion in 2020 to over $3.3 trillion today. So far in 24 alone, the company has added $2.1 trillion in market cap in less than 6 months, right? In less than 6 months, it has gained more than $2.1 trillion in market cap. And this has led NVIDIA to contributing an unprecedented 36% of the S&P 500's return for the year. Now, Alvin Chow, who is a very, very good writer on Substack, Alvin told us he thinks that NVIDIA could hit a $4 trillion market cap very quickly. And he gave us 5 reasons why this could happen. One, he believes that if you look at NVIDIA's forward growth rate, he believes that NVIDIA is still cheaper than Microsoft and Apple if we factor in their forward growth rate. Secondly, NVIDIA is in the business of selling picks and shovels to the tech, to the cloud, to the data center industry. And selling picks and shovels is actually a very profitable business approach. And this is one of the reasons why investments in NVIDIA could continue to do well and could continue to take NVIDIA's stock price higher. The third reason Alvin gave us is getting from $3.3 trillion to $4 trillion is actually quite easier now that they've already risen above $3.3 trillion. NVIDIA just needs another 20% gain in its stock price to hit that $4 trillion market cap. The fourth reason, we know that many index funds and passive ETFs continue to pile into NVIDIA. And one of them, which is the technology sector ETF XLK, they are due to, on June 24th, I believe, next week, XLK is due to increase their weighting in NVIDIA to 20%. Right now, I believe that weighting is somewhere around 6 or 7%. So they're going to be buying way more NVIDIA to bring NVIDIA's weighting in that ETF all the way up to 20%. This translates to about $10 billion of buying of NVIDIA's stock. And at the same time, they're going to actually decrease their allocation to Apple from 20% down to 5%. So Apple is going to be decreased from 20% allocation to 5%, and NVIDIA is going to increase from about 5 or 6% all the way up to 20%. Now, XLK has $66 billion in assets, and that translates to, like I said, $10 billion of buying of NVIDIA stock next week. And the fifth reason why we could see that $4 trillion market cap sooner rather than later is momentum. Stocks that go higher keep going higher. They seem to have kind of an inbuilt energy to keep going higher, whether it's logical or not. I mean, of course, one day that's going to lose steam and the stock's going to go down. But for now, NVIDIA is still in that FOMO stage and momentum is still behind the stock. And yes, it could come down, but it could keep climbing higher and defying expectations for a little bit longer than we think it could. What's the word on the street these days? Well, in this segment, we will cover some major market updates and events. We'll also take a look at a few macro updates if they are important enough to cover this week. And we'll talk about a few important business updates that investors should know about. So let's dive in. Well, this week we jumped into the buyback blackout window for the Q2 earnings season. So this buyback blackout window started this week and it runs all the way through July 19th. Now, if you're a paid investor, you know that I love companies that repurchase or buy back their shares in the open market. It is one of the best ways for companies to give back to their shareholders. It reduces shareholder dilution and it provides downside support and upside energy to that company's stock price. And this is why I love owning companies that have an active share repurchase or buyback program. Now, before we get into each quarterly earnings season, all the companies that are due to report, all publicly held companies that are due to report their quarterly earnings, go into a mandated blackout period during which they are not allowed to share any new news about the company, as well as they are not allowed to buy back their shares until they report their earnings for that quarter. So this blackout period started this week and it goes through middle of July. And the blackout period ends as soon as that particular company has announced their quarterly earnings results. So look out for additional volatility in the more volatile stocks that have these share repurchase programs in place. Because as soon as they enter this blackout period, the company can no longer support their stock price. And so their stocks end up being a little bit more volatile until they're out of their blackout period. This week, Yardeni gave us an update about EV sales in the US. They told us that electric vehicle sales have basically stalled in Q1 in the US. They've only risen by about 2.6% year over year. This is much, much lower than the 46.4% year over year rise in EV sales that we got at this time last year. Sales of new battery electric cars in even the European Union have dropped 12% in May from a year ago. So that's negative 12% year over year. This was actually predicated on a major minus 30% plunge in EV sales in Germany itself. We also learned that Hertz is accelerating the sale of their own EVs in their rental car fleet. Now, Hertz is one of the first rental companies to actually buy thousands of Tesla EVs to add to their rental car fleet. But they abandoned this strategy earlier this year and started selling off these EVs because their EVs were plagued by lower customer demand because customers didn't want to deal with a charging network trying to find a charging station while they were renting the car. And Hertz itself was actually experiencing much higher servicing costs for these EVs in their rental fleet. Talking about EVs, let's talk about self-driving. Now, you may have heard of Google's Waymo self-driving product or service that they actually run. They actually operate in a few cities in the US. Waymo doesn't really get a lot of press coverage or discussion. Tesla seems to kind of attract a lot of the discussion about self-driving cars. But we learned this week that Google's Waymo has already driven more than 1 million miles of self-driving vehicles since its launch in 2018. Google's Waymo operates in Phoenix, San Francisco, and LA, and they soon plan to expand in Austin. They have already completed over 50,000 paid trips per week. They're at that rate of completing 50,000 paid trips per week as of May 2024. In 23, their average number of paid trips per week was only at 15,000. So they've tripled their volume of ridership in just a few months now. The revenues that they get from this Waymo service is estimated at just about $75 million for the year. So it's not a big business, but the potential for this business to grow and become something significant is quite high. Waymo is also priced about 6% higher than Uber and Lyft today. But remember that this is a self-driving car. So if you take a Waymo ride, you don't have to tip the driver. So that 6% higher price might not be a reason to not try them out. Let's talk a little bit about crypto. We wanted to understand who is actually buying the Bitcoin ETFs that were recently approved. Now, these Bitcoin ETFs were approved in January this year. We found out actually this week that $16 billion has flowed into these Bitcoin ETFs year to date. And at the same time, $13 billion has left existing crypto wallets on the blockchain. And this suggests that only $3 billion of net new money has flowed into crypto into these ETFs this year. So let's dig into this a little bit more. BlackRock told us that 80% of Bitcoin ETF purchases have actually likely been coming from what they call self-directed investors who are transferring their crypto funds from their digital crypto wallet that are on the exchange, transferring them into ETFs that they hold within a brokerage account. CryptoQuant, which is a service that tracks on-chain blockchain activity, also confirmed this data. They saw a similar $13 billion decline in Bitcoin reserves across most of the major Bitcoin exchanges since January of this year when these BTC ETFs were launched. So this implies that the majority of the $16 billion of inflows into spot Bitcoin ETFs since their launch likely reflect a rotation from existing digital wallets on the blockchain into brokerage accounts for probably these same BTC owners in the first place. Now, the problem with this is not about the numbers. The problem is that in order for Bitcoin to become a viable store of value, in order for the Bitcoin thesis to play out as a new financial system, what we need to see is more on-chain, more on-blockchain adoption of Bitcoin. We do not need to see less Bitcoin being owned and bought on the blockchain, but that's exactly what we're seeing if we look at these numbers just over the past 6 months. For Bitcoin to become or to create a viable alternative financial system, the blockchain needs to be used more and more by users, and the blockchain needs to continue to attract more funding and more Bitcoin or crypto owners. But that seems to be not the trend that we're seeing so far. Shifting gears a little bit, Michael Spencer from Substack, another very talented technology writer that I follow. Michael pointed out that, talking about talking about Nvidia again, Michael pointed out that while Nvidia crossed $3 trillion in market cap this month, there's actually another semiconductor company that seems to be making similar moves, but not getting as much press for how much the stock has risen so far this year. Now, it is rare for a company outside of the US to hit a $1 trillion market cap, but Taiwan's semiconductor company, TSMC, is actually very close to doing that. Driven by the demand for AI GPUs and chips, which are almost exclusively manufactured by TSMC, Taiwan Semiconductor Manufacturing Company has seen its own market cap jump to almost $940 billion this week. It has made it the world's 8th most valuable company right now, and so it's very close to hitting $1 trillion in market cap. Staying on the AI theme, last week we learned more about Apple's AI plans. I did a very detailed podcast episode about the short-term, the medium-term, and the long-term implications of what Apple is planning to do in the artificial intelligence space and what these developments could mean for users, for markets, and for investors. Apple told us that they would be using their own small language models on the device, as well as large language models. And they also discussed a new partnership with OpenAI through which they will integrate ChatGPT onto their Apple devices, the iPhone, the iPad, and the Mac. So this collaboration was unveiled at Apple's WWDC conference last week, and it allows ChatGPT to enhance Siri and Apple's on-device experiences. Now, the financial terms for this partnership were not disclosed, but sources suggest that Apple is not really paying OpenAI for the benefit of pushing OpenAI's brand and technology onto the hundreds of millions of devices, Apple devices, via iOS 18. Apple actually promised in their WWDC conference, Apple promised to make other LLMs available to users in the near future. So perhaps Google's Gemini could be one of them that is available to users to pick from. Anthropic's Claude LLM could be something that is also available to users. So users will actually have control as to which AI engine they want to use, whether they want to use Apple's native AI engine or ChatGPT or Google's Gemini or something else. And what's interesting is that Apple has actually effectively put ChatGPT and these other LLMs into one corner of their device, into one corner of their operating system. This corner is kind of sectioned off in the UI, and the user has to give permission for that AI engine to use any of their user data. The user has full control over what that AI engine can and cannot do, and no user data can be stored outside of the user's device by any of these AI engines like ChatGPT. So this leads me to believe, as I always had, that LLMs are quickly becoming table stakes. Co-pilots are becoming table stakes. Companies that develop these LLMs and co-pilots will likely not make a lot of money from them directly. LLMs could very, very well be on their way to becoming commoditized if Apple's way of making LLMs available to the end user is successful in the market today. Let's talk about the earnings season very quickly. We've got the Q2 earnings season coming up about 3 to 4 weeks from now. FactSet believes that they expect that Q2 earnings will grow for the S&P 500 companies. Q2 earnings will grow about 9% year over year. This will be the highest earnings growth that we will have seen from the S&P 500 companies since Q1 of 2022. FactSet expects revenues to grow about 4.6%. This will be the 15th consecutive quarter of revenue growth. But 4.6% year-over-year growth doesn't seem like a lot. Corporate profits are hovering at all-time highs, and margins have actually expanded by about 23% year over year. So profits are up, margins are up, but revenues seem to be slowing down a bit in Q2. So we'll see what happens when companies actually start reporting their quarterly earnings. Now let's get into the main topic for today, the US consumer. I wanted to discuss the state of the consumer based on the information that we have at our fingertips today. We have actually not given much attention and love to the US consumer in this podcast for a while now. So let's check in on the state of the consumer. In Q1 2024, the US consumer represented nearly 68% of the US's GDP. The health of the US economy is very dependent on the health of the US consumer. And the health of the US consumer is in turn dependent on a solid job market and wage increases and inflation and a positive outlook on their future. Now, last week we got the latest University of Michigan Consumer Sentiment Report. This is a widely followed consumer survey, consumer sentiment report, because it seems to track really well with the state of the US consumer. And in June, this index went down to 65.6 points. This was much lower than the 72 points that they were expecting, and certainly it was again lower than the 69 points in the month of May. So we saw a dip of about 7 to 8% in the sentiment rating for the US consumer. Now, top of mind impacting the US consumer is, of course, inflation. The US economy has been contending with a very significant rise in pressures, some of the highest that we've seen since the 1980s, after pandemic stimulus measures boosted demand for goods and services in the face of dramatically reduced supply for those same goods and services. But inflation today is well on its way down to the Fed's 2% target. It's well off its peak of 7.1% about 2 years ago. So why does it seem that everybody is still so upset about inflation these days, even though it seems that prices are still coming down? In fact, more and more economists are worrying less and less about inflation because they're actually tracking the year-over-year inflation rate change. Whereas consumers are not looking at things on a year-over-year basis. They are looking at the actual money they have to spend out of their wallets when they buy goods and services. We know that these inflation reports that economists track, that markets track, are primarily based on the year-over-year mathematics. On the other hand, most consumers will recall how much lower prices were at the start of the pandemic around March of 2020, and this is how they measure whether inflation is coming down or going up. In other words, consumers are actually looking at the 4-year percentage change in prices, and they don't like what they see, and rightly so. Inflation frustration stems from the simple fact that prices are dramatically higher than they were before the start of the pandemic. Generally speaking, prices that consumers are paying today as compared to what they were paying in March of 2020, prices that consumers are paying today are about 18% higher than what they were paying prior to the pandemic. For example, gas is about 58% more expensive. Food services are about 25% more expensive as compared to prior to the pandemic. Home appliance repairs, 42% more expensive. Veterinary and pet services, 33% more expensive. Rent is 23% higher. Housing and utilities, another 23% higher. And health insurance is 21% higher. So these are just some examples of categories where consumers are actually feeling the pinch because they are comparing prices that they pay today as compared to what they were paying prior to the pandemic about 4 years ago. Now that said, wage increases seem to be keeping up with these increases in prices. Wage increases for low-income workers, they have actually grown 24% as compared to wages that these low-income workers were getting before the pandemic. Private wages are up 21% over that 4-year time period. Now, on the other hand, there is another way to slice and dice this consumer situation. The number of people working multiple jobs in the US hit a record high of 8.4 million people last month in May of 24. The number of Americans working multiple jobs is at its highest levels it has ever been. Now, why this has happened is not really clear. Perhaps, the hybrid work from home job market has made it easier for people to work more than two jobs, and therefore they're doing it. Perhaps technology has made it easier for workers to work more than two jobs. Maybe they're paying off debt, or maybe they're generating extra income to invest in their family's future. Most of the time, these Americans are actually, though, in fact, working multiple jobs to make ends meet, and the data is supporting that finding. But let's dig in a little bit more to understand what's really happening in the workforce. People in the workforce are also finding that promotions are harder to come by. The labor market has seen quite a measurable slowdown in both job quitting as well as in promotions, leaving fewer opportunities for new and entry-level workers. The annual rate of promotion into management has declined across generations, with only 2.1% of Gen Z workers being promoted last year, and this is down from 2.5% of promotions in 21. Among the 68 million white-collar professionals, only 1.3% of them were promoted during the first 3 months of this year. This is the lowest for any quarter going back 5 years from today, going back to pre-pandemic levels. The share of US job postings with the word senior in the title, that has dropped back to pre-pandemic levels of less than 4%. It was as high as 6% in 2022, when the job market in the US was as hot as it has ever been. The lack of new team formations and reduced hiring actually has contributed more to these trends, where employers are less desperate for hiring workers, they are less desperate for bringing on new workers as compared to the labor supply crunch that we saw during the pandemic, as well as in 2021 and 2022. Now, from the perspective of the consumer, all of this has created a slightly more challenging environment when we think about career advancement, when we think about new job opportunities, as well as when we think about salary raises and promotions going forward. Now, on a positive note, we know that economists are always concerned about the consumer, and recently they've been more and more concerned that the rate of consumer savings has declined. But Yardeni tells us that that really doesn't reflect the whole truth. Yes, the savings rate has dropped from 26.1% in March of 21. That was the peak of excess savings. It has dropped down all the way to 3.2% in March of this year. So from 26% savings rate, it has dropped down to a 3% savings rate over the last 3 years. Markets are worried that the US consumer will soon be tapped out, of their excess savings that they accumulated during the years after the COVID pandemic, the years of 2020 all the way through 2022. And markets are worried that consumer-facing sectors will be impacted by this lower savings rate because consumers will be forced to rein in their spending. They may have, they will be forced to max out their credit cards as well, according to this gloomy narrative. But Yardeni believes that these numbers are actually masking the fact that a lot of today's consumer spending is actually being driven by more and more baby boomers who are retiring and living off the income of their retirement savings while they are spending more and more of their principal at the same time. Baby boomer households today have a record net worth of over $76 trillion. They are the richest cohort of seniors ever in the history of the US. According to census data, of the 86 million households who own their own homes, almost 40% of these homes do not have any mortgage as of the year 2022. Most of them are actually baby boomers. And many of them those that actually have a mortgage, have refinanced them at record low levels of 3% or 4%. A lot of this refinancing happened while we still had very, very low interest rates prior to the year 2021. So the US personal savings rate, even though it is low and it could remain low for a little while longer, real consumer spending is actually quite steady and it could increase along with real personal disposable income, which happens to be coming into the pockets of the US consumer. Now, the baby boomers have been heavily influenced by Spock of Star Trek, that was played by Leonard Nimoy. In Star Trek, which is a sci-fi TV show, Spock was the son of a mixed marriage. His father was a Vulcan and his mom was a human. And he served aboard the starship USS Enterprise as the science officer and first officer, and he later became the commanding officer of that spaceship as well. And Spock was always known to be very, very logical and had a lack of emotion irrespective of the situation in front of him. And baby boomers seem to be following Spock's Vulcan salutation, live long and prosper. Now, they've lived long and they have prospered. Baby boomers have lived long and these baby boomers have prospered. Real GDP has increased significantly over the course of their lives, and both stock prices and home prices have soared at the same time. These baby boomers were born between 1946 and 1964. Today, the oldest are 78 years old and the youngest are 60 years young. They prospered during their long lives along with a rising stock market and a growing US economy. During their adult lifetime so far, the Dow Jones Index has increased about 40x from 1,000 points in late 1982 all the way up to over 39,000 points this week. The S&P 500's market cap has risen from $1 trillion in 1982 all the way to $40 trillion today. Since late 1982, the US GDP has improved or increased or grown almost 8x over that time frame. 760% growth in US GDP since 1982. So these baby boomers are more freely spending on travel, on restaurants, on recreational goods and experiences, and they are most likely contributing in a major way to keeping the US economy afloat. And if we think about the consumer as a whole, Josh Brown from the Compound and Friends had some very, very interesting comments. He said that the consumer is actually making choices today. Between 2020 and 2023, nobody made choices. They just bought what they wanted. They did what they wanted. They were saying yes to everything and they said no to nothing. And this explains the outlooks that we're getting, that we got from companies during those heydays, and as well as that we're getting from consumer companies today. For a few years, people just stopped making any choices at all. They were ready, willing, and able to spend on anything that they wanted. Their bank accounts were flush, labor markets were tight, wages were rising steadily, and everything was a yes. And Josh Brown said that now suddenly we've started getting warnings of slower consumer spending from consumer-facing companies like McDonald's and Walmart and Starbucks and Nike. Inflation and price increases have in many cases kind of hit their limits, and the consumer is saying no thanks on a regular basis. People are actually paying attention to they're paying closer attention to what things cost now, and they're trading down, they're trading lower from brand names to generics. One of the biggest trends on TikTok is actually teenagers filming the burrito baristas at Chipotle while they're making their burrito to make sure that those baristas give them a proper full serving of all of the ingredients as they move down that assembly line. McDonald's has brought back the $5 value meal. Starbucks is also revamping their menu and their prices. And then there are canceled arena tours, rock concert and music tours. Jennifer Lopez recently canceled 7 dates for her North American tour earlier this spring because her tickets were not getting sold out. And then they announced that they had canceled the entire tour because ticket sales were still pretty weak across multiple locations in the US. The same thing seems to be happening for other music performers too. Maybe only Taylor Swift or Beyonce can sell out a stadium these days. But many of these live entertainment venues and events seem to be seeing muted ticket sales these days. In fact, actually, if you go to the most recent CPI inflation report, live entertainment ticket prices they were called out as one of the categories with the highest price jumps on a year over year basis in the month of May. Everybody knows this now, and people are getting more discerning about how much they spend. There are reports of cruise operators also giving out discounts in order to fill their cruise ships. For the first time since the pandemic, airline tickets are falling in prices. This is good news to me. Airline tickets have been falling in prices. They are down 6% so far this summer as compared to last summer. Now, none of this is catastrophic for the US economy. I mean, demand is still healthy, consumers are still spending, but what we're seeing is consumers are not tolerating overtly high prices anymore. Yeah, consumers are still shopping, but they're not buying indiscriminately anymore. Some consumers are beginning to optimize their monthly budgets. Consumers are saying no thanks when it doesn't feel right to pay higher prices. And that's really what has changed. This is what the rest of 2024 will look like until we get into the Q4 holiday season. I think we'll see a little bit of a resurgence in consumer spending in Q4 this year. I mean, to be fair, there are still some other yellow flags as well that we need to consider. The percentage of credit card balances going delinquent is rising, but it's not as high as pre-pandemic levels. The labor market is getting tighter. Labor market is getting tighter. Unemployment ticked up to 4% this past month. We're seeing more layoffs. We're seeing less hiring. Small businesses that employ more than 65% of the US workforce, they are slowing down or canceling their hiring plans. Competition for college internships has intensified as well. Companies are reducing their summer intern hiring numbers. And we're seeing that in the markets today. My own friend, a good friend of mine, his son, who is a rising senior in an engineering school in New York, he had 2 summer internship offers that were rescinded at the last minute because these companies canceled their entire internship programs for the summer. The decline in hiring is particularly acute in sectors like finance and consulting and tech. And then we have AI coming into the picture. Many companies are actively pursuing plans to automate major portions of their operations using AI to reduce the manual labor in these sections of their operations, to cut costs, and to increase profits. Remember, GDP growth for the rest of 2024 are actually quite muted. They are expecting a 1.5% GDP growth in Q2 as well as another 1.5% in Q3. Revenues are not expected to grow, but earnings are expected to grow, almost 9 to 11% for each of these quarters. So how do companies grow earnings if revenues are not growing? Well, they do so by cutting costs. Labor is almost always the largest cost category for any business. And so higher for longer interest rates seem to be finally having some sort of bite in the US economy. And we could see it getting a little worse as we get through the rest of the year. But the US consumer has never been in as good a shape as we've seen today. In case we head into a recession, the US consumer is actually in good shape and could help us along the way. Anyone who wants a job today can actually get a job. Wages are still rising in some industries. House prices are holding very strong. People are still shopping. And never before in the last 15 years have so many people been able to earn so much virtually risk-free in their bank and their brokerage accounts. We're talking about trillions of dollars of income in their 401k accounts, in their brokerage accounts, and even in their high interest savings accounts. These balances have grown. American households' net worth have jumped by about $5.1 trillion, or about 3.3% in the first quarter, according to the latest data that we've got from the US Feds. More than half of that gain, more than half of this gain of $5.1 trillion that we are talking about, that more than half of this gain was due to the rise in prices in the stock market, rise in prices of stocks as well as mutual fund earnings. The US consumer has earned an annualized $3.7 trillion just in interest and dividends in the first quarter this year. So all of this has an effect on the way people feel. All of this has an effect on the way people spend. And this drives household decision making and budgeting. So the state of the consumer is still healthy. People have told us, consumers have told us in survey after survey, that their personal financial situation thus far in this decade is much better off than it was before the pandemic, before the year 2020. The consumer is still healthy, and they might just yet ensure that the US economy makes a nice soft landing this year. So what's coming up in the markets over the next 2 weeks? Well, on Tuesday, June 27th, we'll get a final read on the Q1 GDP growth for the US. On Friday, June 28th, is the quarterly June options expiration, so we could see some volatility towards the end of next week. That same day, Friday, June 28th, we'll get the latest PCE inflation report for the month of May. Remember, this is the inflation report that the US Feds closely follow, and this is what they use to make interest rate decisions. On Monday, July 1st, we'll get the ISM manufacturing report for June, a leading macro indicator that I follow. Tuesday, July 2nd, Chair Powell is giving a speech. I don't know actually where he's giving a speech, but he is, and we'll tune in to see if he says anything different after we see the PCE inflation report, so that'll be telling. On Wednesday, July 3rd, markets are actually going to close early for the US Independence Day holiday the next day. And that same day, July 3rd, we'll get the ISM services report for the month of June. Again, another leading macro indicator that I follow. Thursday, July 4th, markets will be closed for the US Independence Day holiday. And then on Friday, July 5th, even though US markets are open, that should be a very low volume day in my opinion, because most investors and traders will be on vacation, on a kind of an extended long weekend vacation starting the 3rd of July. So that's all I have for this episode of the Market Whispers podcast. Remember to hit the like button if you enjoyed this episode. Drop me a comment or question anytime. I always love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest, for life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.